You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome to the show, Bob.
Yeah, good morning, Jim.
Well, we had a bit of a rebound in the stock market. Is it still continuing?
Yeah, the last item of concern on the downside was right into the 1st of October with the discovery that the huge global mining giant Glencore had huge debts and little prospects. And that put pressure on junk bonds and commodities and everything else. So anyways, as with any announcement of a serious problem, the market would bottom with the news. And then you'd get a relief rally, which we've had. But then it turned into a really brutal short squeeze on the stock markets, on junk bonds, and on a number of commodities. So then last week, this came out and I saw a study on it that the Treasury intervened, and the Fed, I guess, both together, hugely in the U.S. Treasury market, doing an immense repos. It's sort of a device that puts a huge amount of cash in the market. So I saw a chart of it, and it made that effort using this instrument in 2008 look like nothing. So there was massive flooding of the credit markets, which then even the short squeeze even further. And so then now this is getting a little the interesting thing is that the price of crude oil rallied up to over 50, and then it's now back down here. So that gave up rather quickly. But we've been pointing out that and this goes back to the previous crisis with the Shanghai crash that ended on August 24th, that you then had a relief rally out of that, then plus you had the huge efforts made by the Chinese government to make things better. So you had that rally, and then you're getting these serial panics and relief rallies into them, and but this one now is beginning to get a little tired on the upside, I think. But the main thing here is the crude oil is coming down, and that has been associated with weakening stock markets since around June of 2014, when then the crude oil was up to $105 and started a relentless decline. It'll probably go a lot lower too. So a very exciting market with the ups and downs in there. And now on these commodities, as I say, the crude oil and the stock market thing is pretty well linked. But the standard view on it, of course, when crude oil prices started going down, so did gasoline prices. And the standard view is, oh, this is great. It'll put more money in the hands of the consumer. Our view was that weakening crude oil and gasoline prices was part of a slowing economy, which wouldn't do anybody any good. And this latter argument is winning out. So again, looking at the seasonals, you could have expected a rally for copper and crude oil into September, and it's carried on basically into the middle of October for crude oil, but it's now dipping down. The rebound high for copper was a little while ago. So these things now, typically for copper, you can have a seasonal low in October, and for crude oil, you can have a seasonal low towards the end of the year, maybe December, January, in that time window. And it's not going to be friendly for the stock markets beyond, the oil patch stocks.
What's happening on the European exchanges right now?
Oh, they got into a happy period here over the last little while. I think a lot of their, the governments are easy as can be there, and so the way to go is up on it. So they had their high on the stocks over there in April, and down to an important low a few weeks ago, and then they're on a rebound. But there's been some big swings in between. I don't think you can say too much about the European economy, and you also have dislocating problems with so many supposed refugees coming in, which somehow they'll have to contend with. I don't know what they're going to do there. But it's all one corporate financial market. The problem is and then also out of that last problem with Glencore, which you had junk bond prices down and credit spreads widening. We've now been almost 3 weeks of relief in spread widening, and so the last 3 days the credit spreads haven't changed, and then as of yesterday's posting, a little wider. So I think this thing maybe in a week or so, if it gets out to widening, to further widening, that's not going to be a plus. So, gosh, you look at commodities, not so good. You look at credit spreads, relief for a bit, and then back into widening again. And one of the sectors that's been acting much better is on the gold side. We were looking for stability in the gold sector, and it's been on for about 5 weeks now. One of the things we wanted to see for a positive view would be to have the gold shares outperforming the actual bullion price, and that has gone on well, because a couple of weeks ago wrote that if it got above the 50-day moving average, that would be technically positive, and it has, and it's beyond that. So the gold sector has been stabilizing, and in the last week there's been good improvement. So I think this is a very positive step, and I think a little correction in here, not much, just a little bit of a correction, and that'll be a test, and quite likely this is the start of a cyclical bull market for the sector. And looking at the gold stocks, if there's another hit in November, down into November in the big stock market, it would hold back the gold stocks. But what we're looking at here is the industry itself, the gold mining industry. The real price of gold has been improving as many commodities have weakened relative to gold's price. And then on gold's dollar price itself, you recall about 3 weeks ago, we're looking for the rally, and it could go to somewhere between 11.45 and 11.85. Well, it'll get up to 11.90. So our target there has been reached, but I want to emphasize that gold really has moved again to being outperforming commodities. And if you can use it as an example, when gold is outperforming crude oil represents the cost of energy. And you've got a mine going, you've got all kinds of energy being used, fuel for machinery, and you've also hydrocarbons are part of the blasting agents they use. So just keeping track of gold relative to crude oil has been positive. So the sector has been improving probably on a cost basis. Many of the excesses committed by giants in the gold mining industry on the mad bubble up to 2011, gosh, there was a lot of bad business done in there. They were trying to open mines with difficult geology and metallurgy. They're trying to open mines in difficult terrain, and also trying to open mines in politically impossible places. So the whole lot of this is being written off as bad business, and I think we want to look at the whole industry in a much broader light now. I think it really is improving.
We'll have more with Bob Hoye right after the break.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Biotechs were the darling of the stock markets. Are they still?
Oh, no, but they were, gosh. And, you know, it was a wonderfully inventive and productive industry, you can call medical and pharmaceutical research industry, which it is, and a fabulous stock market on that. That index in the U.S., the IBB, in April of 2014, it downticked to, I'm looking at my chart here now, 207 on index, and then in July, it's up to 400. And in my simple mathematics, that's a double. But we had an upside exhaustion, a number of technical things saying that was looking very toppy, and then you've had it, and then down into Black Monday, August 24th, that index sold down to 284 intraday, serious hit, and then rallied up to, in the middle of September, to 366, and that was right against the moving average, and it then failed from there. And the low at the end of September on those problems then was 285. So that was at the panic low of August 24th. There's been some recovery since, but this one has been such a fabulous player in the stock market and reached such an outstanding speculative high that I doubt that this price level will hold. It looks like it could turn around, for some weeks yet. But if it gets below this 285 level, watch out. Then you really would step into a cyclical bear market for that sector, and also would use that for the S&P. After the first hit there in the late August, the rebound was supposed to go up to a certain momentum on our CCI indicator, and it got up to 100 on that one, which was we were looking for. And then down, of course, now what we talked about earlier today is that it's now getting over a massive short squeeze. So then here's the same thing. It can go down, and we expect it to go down and test the low close on August 24th, which it did do. And then it'll go down there now. But if it goes through that level, then you're turning this into a cyclical bear market. They also, one of the leading groups are the small caps, the Russell, the RUT. It hasn't been acting too strongly of late. You know, it's done the ups and downs, but right at the moment here, you had a key rally after August 24th disaster. It made it right up to the 50-day moving average, retreated all the way down to a new low, a lower low than set in August. That was in late September. And then right now it's trying to get above the 50-day moving average. And if it doesn't, that's indicating the sector is not got all that much power. So a couple of important ones. All the banks, BKX, they're during the ups and downs with, say, the S&P, but have been generally weaker than the S&P. Banks have been weak because you've got generally widening credit spreads, and the yield curve is no longer friendly to them. So it's the same sort of thing in here. Weak rallies and weak things trading sideways since the disaster in August. And again, if it takes out that low, that would be a very negative signal for that sector indeed. So I think we just, there's a lot of things to watch here in this markets, and it's always fascinating, and we'll look forward to talking to you next week.
Bob, yes, we certainly will. My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors, their website, institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments for the show to info@HoweStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.